Welcome to my 2017 real estate predictions and best strategies for today. I'm going to have to just give a very brief overview because I think I went an hour and a half the last time I presented, and I don't think anybody's got that kind of time today. So thank you again for joining me here to our 2017 real estate predictions and best strategies. I'm Kathy Fettke, co-CEO of Real Wealth Network, and I want to tell you a little bit about why I care so much about market cycles. It's really been my passion and focus. This is the house that my husband and I acquired basically 20 years ago when we got married. I just did a show on the Real Wealth Show all about how we were able to do that with none of our own money. It was how we got into the real estate business. It's how we made a bunch of money without knowing at all what we were doing. It was just luck. So basically, my father had a 1031 exchange, and we were able to help him with that and help take it over for him so he didn't have any stress around it. And we were able to live in this beautiful house on the top floor and rent out the in-law unit down here. And to the right, another office sort of unit, and then in the back. So we turned this home into a fourplex, and were able to live there for less than it cost to rent. And to rent in an ugly old house. So we got to live in style and raise our kids in this beautiful home in this wonderful neighborhood with good schools. And we just by accident timed it perfectly in 97, which was the bottom of that market cycle. So every year after that, that house made $100,000 until 2007. 2007, when it was appraised for 1.8 million. So we lived there for less than it cost to rent and made $1 million. So it was wonderful timing by total accident. But then what wasn't by accident is that we kept the house. We moved to another house to get our kids into another really good school district, but kept this house rather than understanding market cycles at that point. So that $1.8 million home, had we sold it, we would have cashed out, and yeah, that would have been wonderful. But instead we kept it and rented it out. And then every year after that, it didn't make $100,000. I think it lost $500,000 per year after that, because the house went back down to $800,000 just a few years later. So this is why I care about market cycles and why I care about telling you about it. And this is why I don't care about Fed predictions. As you can see here, Ben Bernanke, the chairman of the Fed, and the Federal Reserve is supposed to be there to stabilize the economy. So they should know a thing or two about markets and market cycles. In 2005, Helicopter Ben said, we've never had a decline in house prices on a nationwide basis, so what I think is more likely is that house prices will slow and maybe stabilize in 2005. Then in 2006, when it was becoming a little more obvious that there was a problem, I certainly knew it, and I'm no economist, and I'm certainly no chairman of any Fed, but he said the slowing in activity will be moderate, then house prices will probably continue to rise. I knew that was not true. And in 2007, when the writing was clearly on the wall, he said, despite the ongoing adjustments in the housing sector, overall the economic prospects for households remain good. And then finally, in 2008, he said, the Federal Reserve is not currently forecasting a recession. In September of 2008, we know that Lehman Brothers collapsed, Merrill Lynch collapsed, the world economy collapsed because of the housing market. So how could this have been overlooked? There's two big problems here. One is either that the chairman of the Federal Reserve, who's here to stabilize the U.S. economy and the world economy, didn't know what was coming, or he didn't want us to know. Either way, it's not good. And especially when at that time, we also had economists and journalists who had no idea what was going on. So in 2005, the Time magazine came out, and okay, journalists maybe aren't experts in real estate, so I will give them more of a break than I would give Ben Bernanke, but still, 2005, Home Sweet Home, why we're going gaga over real estate, and articles in there about how your house will make you rich, and super hot markets, and is it time to buy or sell, and the case for renting, and all this. And then in 2006, David Lee Ray came out. He is, or was at the time, the chief economist for the National Association of Realtors. Again, an organization that probably should have had their finger on the pulse of real estate. 2006, he comes out with this book, Are You Missing the Real Estate Boom? why home values and other real estate investments will climb through the end of the decade, and how to profit from them. Again, 2006, well, we know what happened shortly after that. So he makes me always feel a little bit better when I'm not totally accurate. I say, well, at least I didn't come out with that book. All right. And actually, I did have a publisher who wanted to have me write a book like this, and I knew that something wasn't quite right, so I wasn't ready to write that book, but I'm ready to do it now. All right, in 2010, Time Magazine came out with Rethinking Home Ownership, Why Owning a Home May No Longer Make Economic Sense, 2010. Now, let me ask you this. Do you wish you'd bought a home in 2010? If you did buy a home in 2010, was that a bad idea and did it not make economic sense? Of course not. If you bought a home in 2010, you probably doubled or tripled your money, maybe even quadrupled. So very, very poor advice from those who supposedly are advising us. So that is why I had the Real Wealth Show on iTunes. I had it at KSFO and then KNEW and then a station in Sacramento. But then my husband said, you could podcast this, and so we did, and we've been one of the oldest running podcasts on iTunes and Stitcher for 10 years or so. And so it was that time I knew something was wrong, because I was a mortgage broker, and it did not take an economics degree or a master's or it was obvious something was wrong when I had people putting flyers on my desk at that time saying up to $5 million NINA loans available today. And NINA loans, that went far beyond stated income loans. NINA meant no income, no assets, up to $5 million. So you could come in, fill out some paperwork, say you made a certain amount of money. I didn't have to see your tax returns or anything, no proof whatsoever. And I could give you that $5 million loan. And you know what I could get for that? I could get as much as 3% on the back end, which is an enormous amount of money. And so there was a huge incentive for mortgage brokers to give out these horrible loans. And there was a huge incentive for people to take these loans. So I had the show, and I would ask people like Robert Kiyosaki to tell me if this was normal, because I was fairly new to this business. Rich and I lucked out on that house, and we were landlords, already, but we didn't understand market cycles. The only cycle we knew was up. So I had people like Robert Kiyosaki, and after the show, after I would interview them, I would say, hey, do you have a few more minutes? Can you just tell me what the heck is going on? Is this normal that, I've only been a mortgage broker for a few years, but has it always been this way that I could just give anyone a loan? And, people like Robert Kiyosaki would laugh and say, no, it's not normal. It's dangerous. It's going to be a crash, because eventually people are going to have to make those payments. And when that happens, the markets are going to crash in the most expensive areas. So he said he sold everything in the high-priced markets, and he was buying in affordable markets. And at that time, Dallas, Texas, and Houston were 26% undervalued in their housing market. So just because California and other coastal markets were way, way above affordability, like zero affordability, the only way you could afford a loan was with a teaser rate or, lying about your income. But in other areas like Texas, it was very affordable. But adding to that, it had the highest job and population growth in the country. So we knew there was growth, but we knew home prices hadn't caught up with all that growth. So we listened to him and many others we had on the show because it was pretty obvious. I mean, here, this red line is Texas. Again, this is why I'm so passionate about market cycles. Everybody told me, oh my gosh, that's terrible advice to tell people to sell California. I mean, look at the kind of money people made. This is the national median home price. So California was like up here. And so here, people were basically saying, look at this run up, and it was right about here. So you're telling people to go buy this stuff where nothing's happening and there's no price appreciation, nothing happens in Texas. And, we said, yeah, that's exactly what we want. Nothing sounds real good right about now, because shortly after, of course, that major decline happened, and that is something, but that is not something you want. Whereas Texas just held steady. And then after the crash, then Texas prices went back up. So people basically held on. They were able to save their capital and then get appreciation, and were barely affected by that financial crisis. And again, this is the kind of thing that I was lending on, so I could see things from, from behind the scenes. And so someone would come into me with a house that they wanted to refi, a $450,000 house that brought in $1,200 rent. The numbers absolutely don't make sense. It's total negative cash flow, especially when you factor in the age of the house and the neighborhood, and the rental consistency, which was not consistent, and all the repairs needed on this old house. It was just a bad deal. I wouldn't lend on it, but I could do 100% financing on that, and I could, if someone were buying that, I could give them money back even in the kinds of loans programs that were there. Or I could advise people, hey, you know what, I got a better idea for you. I don't really want to refi your home. That's a piece of garbage. How about you sell it and let's exchange it for 3 beautiful brand new properties in Dallas, Texas, where we know that a new freeway is going in that will cut the commute down from 1 hour to 20 minutes to downtown Dallas. We know it's growing, and so you can triple your rent because it rents for the same amount, as the California house, and triple your rent, but also be in a brand new home that doesn't need all those repairs and everything, and not have to deal with a crash, because how much lower can a $150,000 brand new home go? It can't. And so, sure enough, those properties in Rockwall, Texas, where we were telling people to sell their California properties and exchange them for properties in Rockwall, Texas, and in that surrounding area, well, those values have doubled, if not even tripled in some parts. So it was a good move. And because we would interview people, and Rich interviewed me, and we put a video on our website about what we were doing and how we were helping people, then we started to become more and more experts on these real estate cycles and studying them and helping people prepare and know what's coming. So it was right about then that somebody saw these, what we were doing, and the videos on our website and the testimonials, and said, hey, we would like you to come on to Fox News and debate Robert Shiller, Nobel Prize winner and Yale economist, and of course the founder of the Case-Shiller Index. He has never debated anyone, and he doesn't want to, but we want him to, and so we picked you because he doesn't know who you are and he's not intimidated, and so he agreed to debate me, just kind of a nobody from California. And so I went terrified. I didn't know if I was going to actually make it through that interview, but my husband gave me some great coaching because he had done a national book tour and had been on national TV a bunch. So he gave me some coaching. I showed up, did a lot of breathing, made it through the interview, because at the time Robert Shiller was saying this is a dangerous time to buy real estate. People need to be careful. I have a bad feeling about it. And I would say, well, I'm sorry, Mr. Shiller, but I don't understand. Home prices are the lowest they've been in 10 years or more, 20 years even, maybe 30, and interest rates are at all-time lows. So why would it be a bad time to buy? I don't understand. And if anything, people can lock in this fixed rate for 30 years at these low interest rates and low home prices that are, by the way, 1/3 to 1/4 of what people would pay in rent today. But the difference is that in 30 years, as rents go up, the homeowner has locked in the payment and now in 30 years owns a home free and clear. What does the renter have? Nothing. So I'm sorry, Mr. Shiller, but you're wrong. It is a very good time to buy. And at the end of the interview, he came around and agreed. And so because I guess you could say I won that debate, I've been kind of a regular on lots of different news outlets, and a lot of interviewers who just want to get more of a boots on the street kind of opinion rather than someone who sits and studies data. Here we have a network of 28,000 people. We can tell you exactly what's going on in any market at any time because of our connections. They can tell us what's really going on. Again, not just on data, because if you just look at data, unfortunately, data is old. In the case of the Case-Shiller, it's 3 months old. So it's old data. And if you're studying that, you are you're looking at the past, and we have to look at the future to be able to prepare for what's coming. So let's talk about that. What's coming? Well, first of all, I'm going to let you know right now that I am most likely, without a doubt, going to offend somebody listening to this right now, because if I even mention the word Trump, people hate me or love me. Even if I say nothing about it, even showing this picture, I might get in trouble. So I'm just going to let the cat out of the bag and tell you, you will be offended most likely by the things I'm about to say. So you can either just exit now or have an open mind and hear what I have to say and decide if you think I'm right or wrong. Doesn't matter. All right, doesn't matter to me anyway. I'm just here to share my opinion. So what we don't know is which president we're going to get. We don't know who this guy is. So we're either going to get this presidential businessman, billionaire, or we're going to get this guy. And you know, it just kind of depends on a day-to-day basis. We don't know. So the truth is, it's very, very, very difficult for anyone to predict what's coming. And so the only thing that I can share with you today is the facts that with or without Trump are coming no matter what. And no matter who became president, there are some things out there, some trends that that no policy can change. So let's look at that. But first, just want to kind of go over some of the things that have, of course, happened with Trump. And you know, there's been a Trump bump. Dow breaks 20,000. Will it keep going up? Will it keep going down? Any economist is going to have a different opinion. Some say it's going to take off. Some say it's about to crash. Some say it's going to crash this summer. Others say it's going to be over the next couple of years. And I'm telling you, I just read some stuff today saying, no, it's going to be a bull run for the next 10 years. So no one knows. We do know that bonds tanked and yields increased. And that affected mortgage rates, which have increased from 3.5 to 4.25 and are expected to rise. I don't know if they're going to rise. I think they're going to rise maybe a little bit, but I do think we're going to see a slight, mild, or very serious recession in the next couple of years, in which case I think rates would come down again, but then eventually go back up. So, you know, my advice to people today is look at that rate, 4.25%. Don't be whining or freaking out about that. That is a historically low rate, even though it's gone up significantly since its low last summer. But if you are buying real estate, man, this is a good reason to lock in a 4.25% rate, or with investment properties still under 5%. If either which way it goes, if interest rates increase, you've locked in this low rate. If they decrease, you refi. So don't freak out too much about it. I'll talk about interest rates a little bit more in a bit. Inflation is expected to rise. Well, if that happens, well, your hard assets will go up in value significantly. If there's deflation there, well, then you know, prices could come down in other areas, but it depends on supply and demand with housing. And right now, supply is down and demand is high, so there could be deflation elsewhere, but inflation in real estate, unless a whole bunch of new development comes in, which doesn't seem to be the case. The Fed raised rates in December and promised 3 more. Now, last month, or just a few weeks ago, they didn't raise rates, and I'm going to talk about that and you know, why that might be. And of course, we've had a very job outlook as positive. So right now, I mean, the bottom line is that the feeling out there is everything has changed. Everything's going to get better. Trump's new policies are going to turn this country around. I'm not going to say everybody, 50% of the country, maybe 40%. I don't know, his ratings weren't too great last time, but there's a very large percentage of people who think everything's going to be just great. But we've got to pay attention, because we're in very much uncharted territory, because some of the things that Trump is trying to do have not been done in this particular environment. They've been done in a different kind of environment, but in this environment where we are today, these policies have not been tested. So I'll just do a quick overview. You already know this. I'm going to do it quick. We know that most likely less regulation is coming and an unwinding of Dodd-Frank, which could help loosen up lending and help small banks get back in the business. So that could be very good for real estate, and probably will be. There's an attempt to revamp Obamacare. I don't know if he's going to be able to succeed at that, but if he does, there'll be more money in people's pockets, less taxes on the wealthy, and again, that could stimulate the economy. If he cuts taxes for the highest income earners, the idea is that that's more money that would be spent to stimulate the economy. Increased military spending, whenever that happens, that usually stimulates the economy. And then he wants to help fix the horribly pathetic infrastructure of the U.S. with deficit spending, which means we're going to go more in debt, but the idea is that debt will be offset because there'll be new jobs and more people paying taxes and more going into the system, and again, stimulating the economy. And then bringing jobs back by taxing imports and bringing businesses back, lowering corporate taxes. All of these things are expected to help stimulate the economy again. So there's a lot of stimulus happening, at least expected, if he can get his policies through. So a lot of people say, wow, this is great news. It's a smooth sailing now. It's all good. We're in good territory. And I don't know if you're one of those people. I don't know if you've been investing all your money into the stock market, but since most of you listen to me because you're real estate investors, I'm guessing not. But I think for many of us, this is more the water that we are going to be facing, which is a tsunami. And this tsunami is national debt, which no matter what Donald Trump does, I don't know that his policies can help. I don't think anyone's can. The Federal Reserve doesn't even know what to do right now. We are in uncharted territory. And so we're going to go over that and how you can protect yourself either way, whichever way things go. Make sure that you are protected, that your money's protected, and even further, that maybe you can profit substantially with the changes coming. So, and that's the good news. So I'm going to be a little depressing for a little while, and then at the end of this, I'm going to talk about how you can actually turn things around for the better and invest in the right things that could take you through the storm that could be coming over the next few years. So the green line here is gross debt, and that's national debt. So we know that President Bush doubled the national debt from 5 trillion to 10 trillion in his 8 years in office. And then we know that Obama did the same and doubled again from 10 trillion to 20 trillion during his 8 years. And debt held by the public also increased. So with everything I just said, what's coming next with Trump? Will we see less debt or more? Well, if you just add everything up, he's cutting taxes and doing deficit spending. So that's less money to the government while borrowing more money. So a lot of people believe that it's possible that Donald Trump could also double the debt over his term, just depending on how long if he's there 4 or 8 years, who knows. But what we do know is there's a complete and total intention to get into more debt. And so will his policies end up making up for the difference? Will there be enough stimulus that people have enough jobs, that the increased taxes from all of that and the stimulus would in effect cancel out all that debt? So let's look at that. Here is a chart of our federal budget. And you can see here that 68% of the budget goes to just pay the debt and entitlements. I mean, look at this. So we get, we've got this little chunk here for military, and then we've got this interest on the debt, and then over here is just a little tiny bit for the other things, like education is a little sliver, science, tiny little sliver. So what's going to happen? The military is weak. Technically, we need to be spending more on military. The infrastructure is crumbling. Where's that money going to come from? While at the same time, every single day, 10,000 people turn 65 every day, and that's expected to happen for about the next decade, 10 years. And so this whole section is going to get bigger with entitlements. So where's the money going to come from for all this? Now, Trump's plan, and this is what everybody is so bullish on, anyone who's a Trump supporter is saying, well, yeah, don't you get it? You don't understand the economy. He's going to increase the GDP to 3%. That's what's going to pay for it, which is a 50% increase. So if Trump can achieve that, that's fantastic. I wish him well. I hope it works. But to get to a 50% increase is going to take a lot of work. Can he do it? I think he might. I think he could with the positive outlook out there today. It's possible. The only problem is 3% GDP is only what's needed to pay our interest. It doesn't, and that's interest on the debt. It does not even come close to paying off the entitlements. And as 10,000 people retire every day, and many of them on government pensions, where's that going to come from? So some people say that our debt, when you include that, the pensions and the Social Security and the entitlements, that our debt is really closer to 200 trillion. And so nobody knows how to fix this problem. The only way that President Trump suggested in his campaign that we fix the problem is just to not pay it. And that's pretty much what we've been doing. We just have not been paying it for years. just the interest on it. But how long can that last? If you've ever been in debt, if you go in and get an equity line on your house, oh my gosh, for a little while you feel prosperous. You can go get a new kitchen or go on vacation. You can do whatever you want with that money until you have to pay it back. And so for a period of time, you feel prosperous, and that's kind of where the country has been. We've been feeling prosperous because we've been borrowing so much money, but at some point you have to pay it back. And in the case of many people, just in 2008, they just lost. They couldn't pay it back. Now, if you went in debt, like Rich and I went into Chase Bank back in 2000, I don't know, 6 or something, and went to make a deposit, and the teller said, "Hey, would you like an equity line? I see that your house is worth a lot more than your loan on it." And I said, "Yeah, sure, why not?" And they said, "Okay," and they gave me just right then a $250,000 equity line. So that was a happy day. And yeah, I booked a trip to Hawaii for sure. But also, because Rich and I had the Real Wealth show and I was listening to Kiyosaki, we also decided to invest that money into assets in Texas. We bought a bunch of homes there. And so for that debt, I'm going to call that good debt because we bought assets that were cash flowing in strong markets. And so we went into debt, but it was not any debt I'd be embarrassed about. It was good debt because we were acquiring assets that we were paying off over time with cash flow. It's stuff I teach. So if we are now $20 trillion in debt, what did we get? What did the American people get? Did we get assets of any kind that cash flow? Did we invest in anything? Is our infrastructure better? Is our military stronger? Are our schools better? What did we get? And sadly, nobody can answer that. It just basically went to pay the interest on the debt and entitlements. So we didn't get any assets for it. That's a problem. All right. I'm telling you all of this stuff because back in 2005, when I was truly just a happy housewife and just kind of starting this, the Real Wealth show and learning from others and starting Real Wealth Network and so forth, my gut told me something was wrong. It was just common sense. I didn't need a degree. And so either do you. All you need is common sense. And people, common sense is not that common anymore. People just don't trust themselves. They think other people know more. And I'm here to tell you they don't. Nobody knows what's going on. But you should trust your gut and some of the things I'm sharing with you today. So the Fed fund rate, this is when everybody talks about interest rates going up, that's the Federal Reserve, which is, again, their job is to stabilize our economy. So if our economy just starts revving up and it's just, it's going crazy and everybody's working and there's all this money and the economy's strong, that creates inflation, and inflation can get out of hand. And so the Fed raises the Fed funds rate to slow it down, to make money cost more so that the bank, so that slows it down. But if we're in a recession, well, then the opposite happens, and the Federal Reserve lowers interest rates to stimulate the economy. So you can see back in 82, the economy was really kicking. And of course, and then when we had a recession, well, then the Fed lowered rates. See, so, same thing here. We had everything's booming, and then when it crashed, so since then, since 2009, it's like flatlined. I mean, it's like dead. Like there has been no increase. And so it's hilarious to me that so many people don't understand this, that when the Federal Reserve says, yeah, we're going to raise rates, but then they don't. But at the same time, they're saying, oh, our economy's really kicking in here, look at it go. And yet we're at, 0.5%. Why would they not raise rates? They said they were going to raise rates last year 4 times. They did it once and not until December. And then in December, they said they're going to do it like 3 more times. And they just had another meeting and they didn't do it. So if things were so great, if the economy was so strong, why would they not raise rates? I mean, we're at 0.5%. Like that's nothing. So, to raise rates at this point really wouldn't technically shouldn't have a big effect, because interest rates where they are right now are the interest rates you would have in a major recession. Look at 2009 here. This was a major recession. So why then do we have rates the same as what would be a major recession? Why can't they raise rates? So they're not telling you something. Don't believe them, please. Don't believe them. They're not telling you something. All right. So here's the wild cards. Interest rates, will they go up or down? Inflation versus deflation, GDP growth versus recession, loan requirements, stricter or easier. I'm going to go over this in much more detail at my event tomorrow night in San Diego, and then Saturday at Think Realty. And because I don't have time, I'm rushing through this. But tax cuts or tax increases for an investment, which, by the way, is down from 8% just 3 years ago to 3%. It's down a third. So, how's that going to affect things? In migration and immigration, this is all changing. And then war, terrorist attacks, and natural disasters. I'm just going to not talk about that because that is just too darn depressing and out of my control. So we'll just move on.